In 4 years, between 1,929 and 1,932, I watched 70% of my capital disappear. Not only mine, the capital of people who trusted me, friends, relatives, men who had handed me their savings because they believed I was a careful man. And here is the part that should trouble you. I had been right. Months before the crash, I sat across from Bernard Baruch in his office, and we agreed the market had gone mad, that the speculators had lost their minds, that respectable bankers were behaving disgracefully, that the whole thing would have to end one day in ruin. I saw it coming. I said so out loud. I lost 70% anyway. So if being right did not save me, what did? My name is Benjamin Graham. What you are hearing is a voice rebuilt from what I wrote and taught, not a man commenting on your market today. I do not know your market. I would not presume to. I only know what I learned. And most of what I learned, I paid for in cash. Tonight, I want to leave you with one thing. Just one. I want you to understand why 3 plain words, margin of safety, outlasted every crash I lived through, while the cleverest forecasts around me did not. Not most of them, all of them. We will make 3 stops. First, what a margin of safety actually is, and why it is a cushion for being wrong, not a tool for picking winners. Second, where I learned it, which is to say, how I lost. And third, how you measure it, and why the number is only ever half the story. The other half is the half that ruined me. Let me start with a bridge. When an engineer builds a bridge to carry traffic, he does not build it to hold exactly the weight he expects to cross. He builds it to hold far more. He expects 10,000 pounds. He builds it for 30,000. The gap between what he built for and what actually crosses that gap is not waste. That gap is the whole point. It is the difference between a quiet Tuesday and a bridge lying in the river. A margin of safety is that gap applied to money. Here is the cold arithmetic underneath it. Every business has a value, what it is honestly worth, based on its assets, its earnings, the cash it can be counted on to produce year after year. Call that its intrinsic value. And every business has a price, what the market is asking for it today, this afternoon, this minute. Those 2 numbers are almost never the same. They meet only by coincidence. The margin of safety is simply the distance between them when the price sits comfortably below the value. Now, notice what that means, because almost everyone gets it backward. The margin is not a fixed property of the company. It is not something stamped on the business like a serial number. It lives entirely in the price you pay. The same fine business, the same factories, the same earnings, the same management has a large margin of safety at one price, a small one at a higher price, and none at all at a price high enough. None. You do not earn a margin of safety by finding a wonderful company. You earn it by refusing to overpay for one. A great business bought at a foolish price is a poor investment. A plain business bought cheaply enough can be a sound one. The price is the thing. The price is almost always the thing. Let me separate 2 ideas now, because most of the ruin I have witnessed in my life comes from people quietly blending them together. The first part is arithmetic. How much are you paying set against how much the thing is honestly worth? That part can be settled with figures. A patient person with a pencil and an annual report can do it. There is no real mystery in it. It is tedious. It takes work, but the answer is knowable. The second part is not arithmetic at all. The second part is the question of why a sensible person, a person who is perfectly capable of doing that pencil work, so often pays far too much anyway. Why he abandons his own arithmetic at the exact moment it would protect him. That is not a problem of mathematics. No equation reaches it. That is the psychology of the investor, and it is a different country altogether. Hold on to that division arithmetic on one side, psychology on the other. We will come back to it again and again tonight, and by the end you will understand that everything important happens on the second side. Here is the strange gift of the margin of safety, the thing that makes it worth carving into 3 plain words. Its real function is not to help you forecast more accurately. Its function is to make forecasting unnecessary in the first place. Think about how much of what passes for investing is really just prediction wearing a suit. What will earnings be in 3 years? What will interest rates do next spring? Where the economy is headed? Almost no one can answer those questions reliably year after year, and the ones most confident that they can are usually the most dangerous people in the room. A margin of safety quietly steps around the entire problem. If you have paid 60 cents for a dollar of honest, demonstrable value, you do not need to be right about next year. The gap absorbs your error. You can be wrong about the timing, wrong about the pace of recovery, wrong about a dozen small things, and the distance you bought still carries you across. It is the difference between guessing the exact day it will rain and simply carrying a coat. The coat does not require you to be a better forecaster than the weatherman. It does not require you to be a forecaster at all. It only means the weather, whatever it decides to do, cannot ruin you. That is what a margin of safety buys. Not certainty, forgiveness. I should be honest with you about something here, because a careful listener will already be objecting. You may be thinking, but how can I know a company's true value if even you admit forecasting is a fool's errand? It is a fair objection, and the answer is the heart of the whole idea. You cannot know intrinsic value precisely. I never could. No one can pin it to the dollar. Intrinsic value is not a sharp point. It is a range, a fuzzy region, an approximate figure arrived at from the facts you can actually demonstrate. And that imprecision is exactly why the margin of safety exists. If we could calculate a company's worth to the penny, we would need no cushion at all. We would simply buy at value and be done. It is precisely because our estimate is rough, because it is a careful approximation and not a fact, that we insist on buying well below it. The margin of safety is the room we leave for our own inevitable inaccuracy. The vaguer the figure, the wider the cushion we demand. It is humility converted into arithmetic. So far, this sounds almost too easy, doesn't it? Pay less than the thing is worth. Leave yourself a gap. Stop pretending you can see the future. If it is truly that simple, why did I, the very man who would one day write those 3 words down as the central idea of sound investing, lose 70% of everything I and my investors own? That is the question I have to answer next. And to answer it honestly, I have to take you back to the worst stretch of my life and tell it with the figures intact, because the figures are the only part that does not flatter me. But before the crash, let me tell you a smaller story, because it shows you the man I was before the lesson, confident, correct, and not yet humbled. In the years just before 1929, I made my name partly through a fight with a pipeline company, Northern Pipeline. It was one of the old Standard Oil descendants, and on its books I found something remarkable. The company was sitting on enormous holdings of railroad bonds and other securities worth far more per share than the price the stock traded for. The business itself, the actual pipeline, was almost an afterthought next to the pile of cash and bonds in the vault. Here was a margin of safety you could practically weigh. The market was selling the whole enterprise for less than the liquid securities inside it. So I did the arithmetic, I was certain of my figures, and I went to the management and argued that this surplus belonged to the shareholders and should be returned to them. They did not welcome me. Men who run companies rarely welcome a young analyst telling them their balance sheet is hiding the owner's money. It became a proxy fight, an unpleasant, drawn-out affair, and in the end I prevailed, and the capital was returned to the shareholders where it belonged. I tell you this because it shows the arithmetic working exactly as it should. The value was real, it was demonstrable, it was hidden in plain figures, and patience and nerve unlocked it. I walked away from that episode believing I had mastered something. I had mastered half of something. The market was about to teach me the other half, and it would not be gentle. In the middle of 1929, the Benjamin Graham joint account held about $2.5 million. For a man who had arrived in this country as a boy with nothing, who had grown up after his father died with a mother stretching every coin, that was an extraordinary sum. We had shown only a slight gain in the first half of that year, which, looking back, should have warned me. A market that goes still after a long climb is often holding its breath. Now, I want to be precise about something because it is the crux of the whole story, and it is the part I cannot dress up. I was not a reckless speculator. I prided myself on the opposite, on buying value, on the arithmetic, on caution, on exactly the discipline I had shown at Northern Pipeline. And yet I walked into that crash carrying borrowed money. I held far more in stocks than my own capital could cover, and the difference was financed with debt. Here is the everyday picture of what that does to a man. A strong swimmer can cross a wide, rough lake on the worst of days, but tie a weight to his ankle, and the very same swimmer in the very same water drowns, and his strength makes no difference at all. Borrowed money is that weight. It does not make a calm day worse. It makes a bad day final. Understand this clearly. The market does not even have to prove you permanently wrong. It only has to fall far enough or long enough that your creditors arrive before your judgment is vindicated. You can be right about everything except the calendar, and the calendar will be the thing that kills you. Let me give you the figures now, because they are burned into me and I have never been able to round them off. The crash itself, in the autumn of 1929, took something close to a fifth of the account, roughly 20%. Painful but survivable. I thought, as many did, that the worst was behind us. There was even a recovery the following spring. By April of 1930, the market had climbed back a good distance, and it looked as though the storm had passed. It had not. The year 1930 turned out to be, by a wide margin, the worst single year of the 33 years I spent managing other people's money. We lost a little over half of everything that remained that year alone. More than 50% gone in 12 months. And we were handicapped now in a cruel way. We had already covered our short position, so we had no hedge left, and owing money magnified every decline and put us at the mercy of the people we owed. In 1931, we lost another 16%. By 1932, we had finally steadied. We lost only 3%, which in that wasteland of a year I can only describe as a kind of comparative triumph. 3% felt like winning. But stack those 4 years, one on top of another, and the total is merciless. From 1929 through 1932, the cumulative loss was 70% of that proud $2.5 million. And there is a further detail. My partner, Jerome Newman, and I had stubbornly kept making our quarterly distributions to our investors, paying them out, charged against our own capital because we felt we owed them that. By the end of 1932, what was left amounted to only about 22 cents on each original dollar. 22 cents. For comparison, so you understand, I was not uniquely foolish. The broad market, the Dow, fell something close to 80% across those same 4 years, from a peak of 381 in 1929 down to near 40 in the summer of 1932. Near 40 from 381. So in one narrow sense, I had done better than the market, a relative victory. But I want you to hear how hollow that phrase is. I had been right about the danger. I had bought on value, on careful figures, and I still came within a breath of being wiped out entirely, not because my arithmetic was wrong, but because the weight on my ankle did not care in the slightest whether I could swim. There is a detail in this I have never been able to leave out when I tell it, and I will not leave it out now. Under the arrangement Newman and I had with our investors, we would not earn a single dollar of compensation until we had made them whole again, until every dollar of their losses was repaid in full. That took us roughly 5 years. 5 years of work for nothing, by design, because I believed the people who had trusted us must come before our own comfort. I do not tell you this to be admired for it. I tell it so you feel the true weight of being wrong with other people's money. On paper, a loss is an abstraction, a percentage, a figure in a ledger. But I knew the faces. One of our investors, a steady, imperturbable man, a fighter by nature, broke down in tears after the near total loss of a fortune well over $1 million. The arithmetic was abstract. He was not. And this is where the real lesson finally arrived, not from a book, not from a lecture I gave, but from the floor of my own ruin. I had believed a margin of safety came simply from buying good value at a low price. And it does, but only if you also leave yourself room to be right too early. I had left myself no such room. The debt had erased my margin of safety before the market ever got around to testing my judgment. I had in effect built a 30,000-pound bridge and then driven a 40,000-pound truck across it myself with my own hands on the wheel and my investors in the back. So I learned the thing in the only way that truly teaches. A margin of safety in the price means nothing if you have already destroyed it in the structure of how you hold the position. A bargain bought with borrowed money is not a bargain. It is a trap with a low entry price. After those 4 years, I swore off borrowing to own stocks for the rest of my working life. I missed opportunities because of it. That is the honest cost of caution. You give up some of the good along with the bad, but I never again handed the calendar the power to ruin me. Which brings me to the harder question, the one this whole evening truly turns on. Let me gather what we have so far into a single line, so you can carry it even if you remember nothing else from the first half of tonight. A margin of safety is a cushion for being wrong, and I learned it by losing 70% of everything, even though I had seen the danger coming with my own eyes. Now, here is the question I want you to sit with, because the rest of tonight is my attempt to answer it. If a margin of safety is really this simple, just pay less than a thing is worth, just leave a gap, just refuse the borrowed money, then why does almost no one manage to do it at the one moment it matters most? Why, when the bargains are screaming loudest, do the fewest hands reach out to take them? To answer that, let me take you to the years right after the wreckage, because that is precisely when I found the answer lying in plain sight and watched almost the entire world refuse to touch it. By 1932, the market was not merely cheap, it was absurd. Prices had fallen so far below any reasonable measure of value that the situation became, in a strange way, the easiest investing environment of my entire life and the loneliest. I want you to hold both of those words together, easiest and loneliest, because they almost never travel apart. The moment the arithmetic becomes most obvious is very nearly always the moment when acting on it feels most insane. That is not a coincidence. It is the whole problem in a single sentence. So I set my students at Columbia, where I had been teaching at night, to a piece of plain, dull, unglamorous labor. I had them go through the industrial companies listed on the New York Stock Exchange, hundreds of them, one by hand, in an age before calculators, before computers matching each company's market price against the value of what it actually owned outright. What we found still astonishes me to repeat. A large number of these companies were selling for less than their net assets, less than what you could get by simply selling off what they owned and paying their debts. And some of them, not a rare handful, but a real and countable share, were selling for less than the cash sitting in their own bank accounts. Let me make sure you feel the weight of that. You could buy the entire company for less than the money inside it. The factories, the inventory, the equipment, the ongoing business itself, all of it came free, worse than free. The market was, in effect, paying you to carry the business away. The arithmetic of the margin of safety in those years was not subtle or hidden. It was not a clever insight available only to geniuses. It was screaming in the plainest possible numbers, in the public reports, available to anyone who could read a balance sheet and was willing to do an afternoon of arithmetic. And here is the part I most want you to hear. From 1933 to 1935, the broad market roughly tripled. The bargains were real. They paid, and they paid handsomely. The figures had been sitting right there in the open for anyone with a pencil and the patience to use it. So why on earth didn't everyone do it? Let me put it in the plainest image I have. Measuring a margin of safety is like being offered a dollar bill for 50 cents. The hard part is not the arithmetic of recognizing that it is 50 cents. A schoolchild can be taught to see that 50 is less than 100. The hard part, the part that defeats grown and clever men, is reaching out to buy that dollar, while every voice around you, the newspapers, your neighbors, the broker on the telephone, the man who got rich last year and lost it all this year, is shouting that the dollar is about to become a dime. That is the part no formula will ever touch. That is the part I could not teach with a chalkboard, no matter how many years I tried. Here again are the two halves, and now you can see exactly why I separated them so carefully at the very beginning. The arithmetic gives you the distance between price and value. That is genuine work, but it is honest work, and crucially, it can be done. You estimate what a business is worth conservatively, and I mean conservatively, based on what it owns and what it dependably earns over a span of years, not on the dazzling future that some salesman has painted for you. You take the value that is justified by facts, not by hope. Then you set it against the price. The gap between them is your margin of safety. And you do not cut it close. That is the discipline within the discipline. You do not try to buy a business worth $83 for $80. You insist on real generous room because your estimate of value is itself a careful guess and not a fact, and the room is precisely what forgives the error in your guess. Let me give you the other face of this same coin, because it is just as deadly and far more seductive. The danger is not only paying too much for a mediocre company. The more tempting trap is paying too much for a genuinely wonderful one, a growth company, the kind everyone admires. People look at a company that has grown its earnings briskly for a few years, and they project that growth forward into the distance at the same dizzying rate, and they pay an enormous price for that imagined future. They leave themselves no room at all. And if the growth merely slows, not collapses, merely slows to something ordinary, the price has so far outrun the value that there is no cushion to catch the fall. A growth stock is only a sound investment when it, too, can be bought at a price that offers a margin of safety on conservative assumptions. Otherwise, you are not investing. You are paying full retail for a forecast, and forecasts, as I have told you, are the one thing the margin of safety exists to make unnecessary, but the other half, the holding, the discipline, the sitting still while you appear to be a fool, that half is not arithmetic at all. And it is the half that defeats people. In 1932, the figures begged to be acted upon. They were not in dispute. What stopped men from acting was not a failure of calculation. It was fear. It was the simple, deeply human inability to buy when buying felt like stepping in front of a moving train, when every instinct and every neighbor told you that the safe thing, the sane thing was to stay out, to hold your cash, to wait for a clarity that by the time it arrives has already taken the bargains away with it. So let me be honest about what a margin of safety is and is not, because I have watched it sold in the years since as a kind of magic charm, and it is nothing of the kind. It does not guarantee a profit. I have said this plainly, and I will say it again, because the people who forget it are the ones who blame the idea when they are really to blame themselves. Requiring a margin of safety does not remove the possibility of loss. It cannot. What it does is tilt the odds. It makes a loss less likely and a gain more likely. That is all it does. That is enough to build a life's work upon, but it is all, and anyone who promises you more than that is selling you something. This is exactly why I have always insisted that a margin of safety be paired with diversification. You will be wrong about individual companies. I certainly was more than once. Even with a careful margin of safety on each one, some will disappoint you for reasons that no balance sheet on earth could have revealed in advance: a fire, a fraud, a change in the world that no one foresaw. So you hold a basket, not one or two cherished favorites that you have fallen in love with, and you let the margin of safety across the whole collection do its quiet, patient statistical work. The margin protects each individual position as best it can. The diversification protects you from your own dangerous certainty about any single one of them. The two together are far stronger than either alone. A margin of safety, in the end, is not a formula that abolishes risk. Nothing abolishes risk. It is a way of choosing systematically and soberly among unavoidable risks, paying in effect for the right to be wrong without being destroyed. That is the whole of the thing, dressed in 3 words. Let me give you one more story, because I have spent so much of tonight on how I lost that I owe you a glimpse of the other side of what this discipline does when it is given enough time and enough patience, and it carries a lesson inside it that surprised even me. In 1948, my partnership bought a large stake, about half of a small insurance company. It was a modest, unglamorous business with an awkward name, the Government Employees Insurance Company. We paid something on the order of $700,000 for our share. It was, by the careful arithmetic I have described to you all evening, a sound purchase, a solid business, available at a reasonable price, with real value behind it. Then an inconvenient thing happened. We discovered that under the regulations of the time, an investment firm such as ours was not permitted to own an insurance company outright. So we were forced to do something unusual. We distributed the shares directly to our own investors, handing each of them a piece of the company in proportion to what they held in the fund. Now, here is the part that humbles me even in the telling. That single holding, that one modest insurance company we were practically compelled to give away to our shareholders, went on, over the following 25 years, to grow into something worth not hundreds of thousands, but hundreds of millions of dollars. By a wide margin, it became the most profitable single decision of my entire career. More profitable, in the end, than the sum of all the clever, painstaking bargain hunting I did across 30 years of poring over balance sheets. And I want you to notice what that does and does not mean. It does not mean I had foreseen any of it. I had not. I had no crystal ball that showed me what that company would become. I had only done two things. I had bought it at a price that offered a margin of safety, and then circumstance and patience let it run. The arithmetic got me in the door at a sensible price. After that, it was time and the discipline not to sell too soon that did the work. Even my single greatest success was not a triumph of prophecy. It was a triumph of buying cheaply and then sitting still. That is the quiet truth the margin of safety keeps trying to teach and that I keep having to relearn. The number gets you safely in. Everything that happens afterward depends on a kind of patience that no balance sheet can supply. Now, I want to bring this home, and I want to bring it home to you in particular, because this is the part the arithmetic can never reach, and it is the part I would most like you to remember when the figures have faded. You have been listening, I suspect, as though the danger lived out there in the companies and the market in the next crash that is surely coming for someone. Let me tell you, as plainly as I know how, where the danger actually lives. It does not live in the balance sheet of any company you will ever buy. It does not live in the headlines. It lives in the person who looks back at you from the mirror each morning while you shave. I am the proof of it, and that is why I have spent half of tonight telling you how I lost rather than how I won. I saw the crash coming. My arithmetic was sound. I had already proven at Northern Pipeline that I could read a balance sheet better than the men who ran the company. And I still lost 70%, not because the numbers betrayed me, but because I was a human being. Human beings reach for borrowed money when the borrowing is easy. Human beings cannot bear to look foolish in front of their neighbors. Human beings sell at the very bottom and buy at the very top because the crowd is doing it, and the crowd in the moment always feels like safety. It never is. It is most dangerous precisely when it feels most safe. A margin of safety guards your capital, but holding on to it, actually keeping the discipline when the market is roaring on one side or screaming on the other that asks for something no number can ever buy you. It asks you to be the kind of person who can stay calm while everyone around you is not. To do the arithmetic, trust it, and then sit quietly with the result while the world tells you that you are a fool. That is far harder than any calculation I ever put into security analysis. I spent 2 long books and the better part of a lifetime working out the arithmetic, and I will tell you, at the end of all of it, the arithmetic was the easy part. It was always the easy part. Let me leave you with one practical piece of self-knowledge, because it is the closest thing I have to a personal instruction. There are broadly 2 honest kinds of investor. And your first task is to know, without flattery, which one you are. There is the defensive investor, who wants chiefly to avoid serious mistakes and serious losses, who does not wish to spend his evening studying balance sheets, and who should therefore hold a sensible, diversified collection of sound securities and largely leave them alone. And there is the enterprising investor, who is willing to devote real time and real care to the work, and who may, in exchange for that effort, reach for somewhat better results. Both are respectable. Both can succeed. The disaster, and I have watched it happen more times than I can count, comes from the man who wants the enterprising investor's returns while doing only the defensive investor's work, who wants the reward of diligence without the diligence, who confuses the courage to act with the homework that earns the right to act. So ask yourself, plainly and without vanity, which one you truly are not, which one you would like to be at a dinner party. Then behave accordingly. The margin of safety serves both of them faithfully. But it cannot serve a man who has lied to himself about how much work he is actually willing to do. The numbers do not lie, but we lie to ourselves about the numbers. And that small dishonesty is the seed of most ruin. There is an old line, far older than I am, that the fault is not in our stars, but in ourselves. Shakespeare wrote that, not I would not steal it. But he might as well have been writing about Wall Street. The market does not ruin most investors. Most investors ruin themselves patiently and thoroughly over many years, and the market merely keeps the score and hands them the bill. I have made my peace with that. I made every one of those mistakes myself. After all the borrowing, the holding too long in 1929, the certainty that I was too careful to be caught, the market did not single me out. I walked into it on my own 2 feet with good arithmetic and bad temperament, and I paid the tuition. What I am offering you tonight is simply the receipt for that tuition, so that perhaps you can learn the same lesson at a discount with a margin of safety, you might say, on the cost of your own education. So here is the one thing I want you to carry out of tonight if you carry nothing else. Those 3 words will not make you smarter. They never made me smart enough to avoid the worst 4 years of my life. What they do is humbler than that and far more useful in the long run. They make sure that when you are foolish, and you will be foolish, I promise you that, just as surely as I was, the price of your foolishness is something you can still afford to pay, something you can survive, something you can walk away from, bruised but alive, to invest another day. That is the whole of it. Pay less than a thing is worth. Leave yourself room to be wrong. And understand, above all, that the room is not really there for the market's mistakes. It is there for your own.